Right, so we're still classifying costs. I'm going to speed up a tiny bit. We are still classifying costs, but this time we're going to classify them based on their behavior, which if it goes by any of your behavior, it's not going to be good. But we got fixed costs. Fixed costs, there's a definition, they are constant, regardless of the change in the level of activity. So if you look at your little diagrams down there, you will see that the fixed costs, just quickly get a yellow pen, the fixed costs that no matter what the output level does, they stay fixed over a period of time. And if you look at the cost per unit, so let's say that fixed cost would be an example of renting a classroom when you want to give a lecture. Then if the rent is 200 Rand or 200,000 Rand, just leave off a couple of zeros, and you've got 10 students, the cost per student would be 20 Rand. But if you've got 20 students, the cost is 10 Rand a student, and 6 Rand 67, and 5 Rand a student. You got the idea? So the cost per student will come down the more students you have. However, the cost itself is fixed. So the cost per student will go down and down and down and down. It'll never reach zero though, hey? You got the idea? And it's not a straight line either. All right, so fixed cost, go and read that up as well. And these are things that you need to understand, as I said, going forward. It's your foundation. So if you don't go home and read these, you're going to be lost tomorrow and the next day, and from then onwards, okay? So please that's the only homework I'm asking you to do, is reread this theory. Right, and then the opposite of a fixed cost is a variable cost. So those would be, example, your notes that we print you. It costs 10 Rand or 50 Rand or 100 Rand or whatever to print a set of notes for each student. If there's one student, my notes will cost 100 Rand for printing. If there's 10 students, it'll be 10 times 100 Rand. So variable cost varies in direct proportion with the output. Output is your level of production, okay? So here is a little example. If your variable cost, the cost per unit will be the same. Do you agree? So the cost per unit is the same per person, or per unit, as I said. But the more I produce, the more it's going to cost me. So if I make 10 units, I'm going to spend 20 Rand. If I make 20 units, I'm going to spend 40 Rand, and so on and so on. So the more I have, the more I make, the more I spend, it goes up. But in a straight line, because it's a fixed cost per unit, however, variable costs vary in direct proportion to production. Production, output, same thing. Happy with that? Nice and easy. Right. So now we've got a semi-variable, or we also call it a mixed cost. So that is something with a bit of both. It's got a little bit of fixed as well as variable costs. That would be like a cell phone contract. A little portion of it is your rental or your actual contract agreement where your phone is included, and then you pay per call after that, or per minute that you have phoned. You got the idea? So that is an idea. Or if you look at salaries, you've got a basic salary plus commission. So you'll have a fixed portion, and then on top of that, you'll have a variable portion, which essentially is that added on to the fixed costs. Does that make sense? So what we are going to do, whenever you've got a fixed cost, a mixed cost or a semi-variable cost, you have to split it. And that's part of study unit 2 that we're going to do now. And that's maths. So cost accounting brings a lot of more maths in, but not terrible. And hold that thought till next year. But then you've got to remember how to work with logarithms. But don't worry, if your lecturer is there, she helps you. But don't get scared. Have I ever left you in the lurch? I've shown you what to do, how to do. Anyway, so you understand the concept, right? Then you get, just like we get semi-variable, you get semi-fixed. We also call them stepped costs. So now if you look at our room, and it can seat maybe 50, let's just say it seats 50 people. As soon as I've got 51 students, I can't sit in this class anymore. Then I've got to rent a second room. Does that make sense? So a stepped cost, certain type of costs increase or decrease in fixed increments, or your rent increases yearly. You know, so it's constant, it's a fixed cost for 12 months, and then it goes up and then it stays fixed again. Can you see the step concept? So it's there until either time or units, then it goes up because you need a second room because you've got too many students for this room, whatever the case is. You got the idea what that is? That is still considered a fixed cost, and we won't deal too much with that in the syllabus as long as you know it exists and can define it. So we are now going to talk quickly about relevant range. So in other words, within this range, the fixed costs are so much. Within the next range, or time frame even, does that make sense? The costs are fixed. That's what we're talking about. So the relevant range would be defined by the production capacity within which you normally operate. So within this, the fixed costs are that. But if we go beyond that, then it might change. We might need a second machine, which would depreciate and so on. Or a time-specific one. So I just want to have all my colors, otherwise Patty gets very upset. Don't we know that by now? If it's within a specific time period, then after it'll be relevant, as in fixed, for a specific time period, but then it might change in the future. For example, your rent might increase after a year, or inflation might increase the price of your products, or whatever the case. Or when we produce so many products, we can qualify for a bulk discount, then your price will come down after so many products. Looks like I'm doing some breakdowns, hey? But you've got the idea. So doesn't just go up necessarily, can come down as well. Got it. Right. Now, this is pure theory, so you're going to be doing some reading yourself again. Product or period cost. Very simply, a product cost is anything to do with the cost of the product, materials, labor, and overheads. Anything that you will allocate to the product, whereas a period cost is things that don't have anything to do with the product, like the rent of your admin, and we take that as a period cost. Now, if you think of your financial statements, you had sales minus cost of sales on your profit or loss, gives you gross profit, plus other income, minus selling, distribution, admin, and other expenses, and then finance costs gave you profit for the year. So your manufacturing costs are those that will go into the cost of sales section, because they are to do with the cost of the product, the thing that you sold. You could buy it in, or you could make it yourself. But your selling and admin are always in the bottom bit, and that bottom bit is what we call period costs. You got the idea? They've got nothing to do with the cost of the product. Does that explain what you were asking earlier, hey? Okay, so cost of sales is manufacturing costs or product costs. And then selling, admin, and other are period costs because they've got nothing to do with the product itself. All right, so there's just definitions you need to look at, and they do ask you, show the journal entry to record a product cost or a period cost. When you record any costs, you debit what you pay for, whether it's advertising or stock, or materials or labor, or whichever overhead. You will credit the bank or however you've paid for it. Easy enough. So unfortunately, your basics don't disappear. And then don't forget, when that inventory gets sold, you need to remove it from inventory and put it under cost of sales. Or you need to remove it from materials or labor, and eventually it lands up in cost of sales. We are going to do the physical accounting in this course as well. All right, you happy with that? Good. So there's nothing majorly difficult, and that is the end of study unit 1. Let's